Looking at that, it doesn't look that good right now, but markets do continue to hover near all-time highs, driven largely by a small group of AI-powered tech stocks. But are these names beginning to run out of steam? And is this the start of that? Where else can investors find some opportunity? Well, we have Mike Philbrick, CEO of Resolve Asset Management, with us to help break down what's kind of unfolding right now. And Mike, thanks very much for joining us.
Thanks for having me, Roger.
Have we ever seen a market like this where one a relatively small group dominates the way it has?
Yes, actually, it's happened a couple times in history. One is the Nifty 50 in the late 60s. Another was in the tech bubble. And to some degree, when we had the resource boom in 2007, 8, you had Exxon and those large oil companies actually dominating market cap of the S&P 500 as an example. So it's not a unique occurrence.
Now, we know what happened with the tech boom, but what happened in the 50s with the Nifty 50?
The Nifty 50 with the late 60s was
similar.
Late
60s.
Yeah, it was similar, but it was, again, driven by valuation. And I think that's one of the key discriminating factors here. Like right now, we're in the middle of a bit of a selective bull market, not a broad one as of yet. And that's being driven by a once-in-a-generation capital cycle that is tied to the AI rollout. And that's driven by a huge convergence of software and hardware investment. The largest companies in the world are spending tens, if not hundreds of billions of dollars on data centers and semiconductors and grid upgrades, power capacity. And that build out is real. It's global, multi-year, and that's why the leadership has remained narrow at the top of the market.
Now, does I feel like this might only have two directions. One is really good and one is not so really good.
Well, if we can draw some similarities, so the tech bubble, and there's a bubble in calling bubbles, if you will. But if you think about the darling back then of Cisco Systems, and it was trading at 120 times its forward earnings, that's when you get into those bubble-like time frames. And it's not like they were wrong. The network did build out. The internet was a big thing. It did get overvalued. NVIDIA is not at that level. NVIDIA is looking like, trading at 30 or 40 times its forward earnings, depending on how you want to estimate that. So, and those earnings are based on, and the valuation is based on the growth factor. And the growth is there, and it's real, and it's global. Now, that's at the same time, you're seeing that K-shaped economy, and we see that in the Challenger report this morning with more layoffs. Underneath the surface, companies and households with strong balance sheets are holding up quite well. If you're credit sensitive, those areas are a little bit slower. So I don't think the playbook is, get out or get all in. It's stay invested and be selective.
But that's a difficult thing to do right now. Where do you get selective?
Well, I think you want to think about high quality balance sheets. You want to think about exposure to the physical build out that's behind AI. Those cases remain intact. You definitely want to be careful of the more speculative areas where the narrative has run ahead of the earnings. And so, I think you want to focus on quality. You want to participate in that AI build out. You want to keep real assets like gold in your portfolio and high quality bonds. You want to have them in the mix to balance the portfolio, make sure the volatility doesn't run you over, because we've got lots of policy uncertainty that we're seeing. And we're likely going to see that continued policy volatility. So having some defensive assets in the portfolio provides some resilience and the ability to rebalance opportunistically as cycles evolve.
What do you think would bring some stability to that?
Well, I think from a defensive perspective, most clients are underweight gold. We've had a bit of a pullback in gold. It would probably serve a good purpose to hedge a little bit of the geopolitical risk, the monetary uncertainty, and those types of things with an asset like gold, because it's structurally different than your stocks and bonds. Stocks and bonds respond to interest rates and earnings and things like that, whereas gold responds to geopolitical uncertainty, fiat uncertainty, monetary debasement. So it's definitely one leg in the stool. And definitely don't underestimate the impact of having some, 5 to 10-year bonds in the portfolio, because as we cut rates, those tend to do a little bit better. And simultaneously, stocks can do well there too. We saw this morning more news out on job cuts, and the Fed is in a tough position with cutting rates because they're worried about inflation. But the moment that hawkish commentary from Powell looks a little bit offside, you have inflation continuing to attenuate. You have gas at the pumps going down. and you have the continued degradation in the employment situation. So, I think it's going to become pretty obvious that another rate cut is required in December.
And what do you think that will do if we do see that rate cut?
I think that will continue to allow those parts of the market to do well, those narrowly focused parts of the market to do well. And we've got a few things that we're going to talk about today about ways in which you can think about that, like specific ETF ideas. And I don't know if that's where you want to jump off to now or how we want to proceed.
Let's go for it. Go for it.
Yeah. So when you think about the AI adoption and you think about how that runs on a bit of an S curve, well, that adoption is a technology S-curve. It goes very rapidly, but it's also met with the J-curve of the resource development that provides it. AI is not built on, the cloud and vibes. It's built in those data centers and those GPUs and the power capacity required. So you want to get exposure to those areas where it's the picks and shovels, if you will. So if we talk about XBM, the iShares Global Base Metals ETF trades on the TSX, that is giving you exposure to that copper, nickel, aluminum, and those types of things, which are the actual materials required to build the data centers and the grid capacity. And those aren't really trading at high multiples. So that's one way. And another way that's an extension of that is in Canada, we're blessed with having, a resource-based economy. Mm-hmm. And so if you look at those mid-cap equities in Canada, represented by the XMD, the iShares TSX Completion Index, you're talking about the companies that are outside the TSX 60. So this has more exposure to industrials, energy services, pipelines, rail adjacent suppliers, and mining developers. And that's the part of the economy that's going to benefit directly from the capital spend in the commodity cycle. And so that's another way. Those two ETFs are good ways to think about the picks and shovels that are going into AI that have a little bit less in the valuation side and have good trends and are having a bit of a pullback as we're having this moment of funding uncertainty and I think, the first couple of weeks in November can be a bit bumpy, but I think we're going to reassert trends as we get into the end of the year.
Okay, and one other you want to talk about, we can sneak in here, Horizon's Global Uranium Index. Does nuclear feel real to you then, that it's having this renaissance?
Absolutely. So the fastest growing sources of power demand are those data centers, and nuclear is the answer. And so you saw recently the government signed major nuclear deal with Westinghouse, which is owned by Brookfield and Cameco. And so that's not just about the procurement of the U308, but it's also about the deployment and development of small modular reactors across the U.S., 10 to 13 new reactors. So that's another way you can take advantage of what's happening underneath the surface. Now, if you want to think about a little bit more, broad exposure, then go with quality and complement your market cap weighted sectors, like let's say you've got the S&P 500, well, complement them with a quality based ETF, like the Fidelity US High Quality ETF, trades at TSX FCUQ. And within that, you're looking at companies with high return on capital, stable earnings, and low leverage. They've got pricing power in their margins. So this is the upgrade layer to complement your market cap strategy with, and it gives you increased quality and reduced downside variability on that equity allocation.
Okay.
And so focusing on a little bit of quality helps too.
All right, we're going to have to cut you off there, Mike, but thanks for joining us. I always appreciate it.
Thank you.
Mike Philbrick is the CEO of Resolve Asset Management.